How to finance an Airbnb, and let's get started. So you're looking at a property to purchase, and it's going to be a short-term rental property. And so there's a couple ways we size these up for financing. Okay, so if you're going to plan on occupying it at least 14 days out of the year, you could probably buy this as a second home. Check with a conventional lender on their guidelines specific to that. Now, the borrowers I deal with are strictly investors, meaning they're not going to occupy the property. They're buying this strictly for business purposes. And so what are the options to financing this? Well, first, we're going to look at this as a DSCR loan. So we're going to ask what the property taxes are, what the annual insurance is going to be. Is there an HOA? How much is that monthly or annually? And then if this were to be a long-term rental, what would the monthly rental income be? And from there, we can calculate based on long-term projections, would this qualify? And let's just say it doesn't. The DSCR is well under 1% or 1.25, which is the debt service coverage ratio we're looking for. There are projection-based lenders, and they'll use like AirDNA or an algorithm similar to AirDNA to say, okay, this property should do X amount of dollars in annual revenue based on 75% occupancy with an average daily rate of X. And that's what I call a projection-based DSCR loan. All right, so there's a couple lenders that actually do projection-based. Now, if you're buying a previous vacation rental property or Airbnb, some programs allow for you to get the seller's financials from Vrbo or Airbnb, and you can use those for DSCR qualifying. So one is first, we're going to look to see if it would qualify from just a long-term rental standpoint. If it's not currently rented, they'll do a rental survey. So if we know what those rents would be for long-term and it qualifies, we can go that route. If it doesn't, we could go projection-based. And or we can do what's called a flex bridge loan or a stabilized bridge loan, where this is just an asset-based loan. We can go up to 70 to 75%. They've started to cut down. We were doing 75, and now latest guideline said 70 on this program, where we'll just go based off the purchase price and your credit score. We can do up to a 24-month term on this product. The advantage of this is there's no DSCR requirements. It's an interest-only loan, and there's no prepayment penalty, which allows for you to season the property and then refinance maybe after month 12 or beyond. We're in a higher interest rate environment right now, so probably in the next 24 months, rates should start to come back down. Granted, nobody's got a crystal ball, but this is a strategy that I see a lot of short-term rental investors utilizing right now to season the property to get 12 months of operating income where they can verify that when they do the takeout. They can then put the income on their personal tax returns or their business tax returns, which trickle down onto their personal tax returns, and maybe they can qualify from an income standpoint, or they'll just go into a DSCR loan as rates come down. So that's a flex bridge loan or a stabilized bridge loan. So first thing we do is we'll qualify from a long-term rental standpoint from a rental survey. So when the appraiser goes out, they'll do a rental survey and says, based upon market comps, this should rent for X amount of dollars. If no, can we do a projection-based loan, a DSCR loan? And if the rates are high and you're looking to capitalize as rates come back down, then you would maybe look at the stabilized bridge loan or the flex bridge loan. The other thing is, if this property is a value add type property, you can potentially get a fix and flip loan for 12, 18, or 24 months, and you could fix the property up. Then you could season it and get your income for 12 months. Now you have income verification. You could do a DSCR takeout, or potentially you can do a conventional non-owner occupied refi after 12 months of seasoning. So those are your options. There's quite a few options, but that's how we break it down, and we say, okay, based on what we are working with right now, here are your best options. Book a call below. We can discuss your project in detail. I'll give you a couple different ideas and some scenarios, and we can figure out what might make the most sense for you. Anyways, hope you enjoyed this episode on Airbnb financing, and I'll see you on the next one. Hey guys, Beau here. If you enjoyed what you saw, please subscribe to this channel. We talk all things financing. I've been in the lending industry for over 20 years, and I'm happy to answer your questions and provide great content.